All right. Good morning, everybody. Good morning to all you magnificent melon heads out there. Today is Wednesday, February 7th, 2024. Top story this morning is once again New York Community Bank, ticker NYCB. The troubles just keep mounting at the United States' most distressed regional bank. They had disastrous earnings last week, led largely by commercial real estate. There were some big losses in office, but mainly it was that rent-controlled multifamily real estate that was causing all the problems over at NYCB. Did a video about that one. It was gross, that video about how charities are just pigging out and the FDIC never sold those assets and they're paying themselves millions of dollars. Total mess over there. Well, NYCB is in the news again this morning because Moody's has cut their credit rating to junk. Not very surprising. They're citing the decline in earnings, the risk to commercial real estate, but also the very shady circumstances surrounding the departure of their chief risk officer and their chief accounting executives in the months ahead of that disastrous earnings release. And as JP Morgan is saying this morning in a note in their downgrade of New York Community Bank, why the hell did we find out about that months later? Why was that not disclosed by the bank immediately? When senior executives, especially the chief risk officer, leaves a bank, you need to get out in front of that. You need to post that right away. Otherwise, people wonder, why are you not telling us right away? And when we find out after you post hundreds of millions of dollars in loss provisions for all of your worthless commercial real estate, well, then, yeah, you can expect to have your rating cut. Now, there was all kinds of comments and reports came out last night. The bank is saying, don't worry, we're well capitalized. We have ample liquidity. They're strong and resilient and all that Janet Yellen garbage. They had a new executive chairman, Alejandro Danilo, was just appointed, and he should probably stop talking because at one point this morning, shares in NYCB were actually up over 16%. It was on having a nice little bounce here, and I'll, relatively speaking, right, it's sold off more than 50% in the last couple of days. So a bounce from here of 16% isn't really that big of a move. But then Mr. Danilo comes out and makes a statement about virtually no withdrawals at retail branches. I'm paraphrasing here. And the stock went from up 16% to up only 3%. So maybe Mr. Danilo is probably a good time to cut the mic, quit while you're ahead. Just throwing that out there. So NYCB, again, back in the news today, guys. They will not be the last bank to report trouble from U.S. commercial real estate. It is spreading, and it's not just in the U.S., because we had another bank in Germany yesterday reported problems. Deutsche Pfandbriefbank, I hope I said that right. Deutsche Pfandbriefbank had their debt downgraded, citing what? Risks of U.S. commercial real estate. We've got two banks in Germany. It was Deutsche Bank last week. Now it's Deutsche Pfandbriefbank. Then we had that bank in Japan. The name eludes me at the moment. Azora, I think it was called. They were downgraded. They posted big losses over losses in U.S. commercial real estate. The NYCB thing. And it's still very early in the commercial real estate crisis here in the States, guys. Most of these buildings still haven't been written down. There's still over $1 trillion of debt that's going to mature over the next few months. So we're going to be hearing a lot more about commercial real estate here in the States. Also, Alibaba's making the news today. Never mind that Alibaba just posted terrible earnings. Never mind that the revenue was a miss. It was only growing 5% year over year. Never mind that net income was down 69% year over year, mostly due to mark-to-market changes in their investments. All the companies Alibaba bought are not worth what they paid for them anymore. But Alibaba came out and said, forget all that, because here's another $25 billion for a stock buyback. And guys, that is a monster buyback. And that was just an additional $25 billion. That brings the total money available to $35 billion for Alibaba's available share buybacks. And I see my internet is a little wonky right now. I don't know if the picture's getting grainy or if I'm getting my robotic voice or not, but we're going. This is live. $35 billion worth of share buybacks available. Guys, the market cap of Alibaba is like $195 billion bucks. So this is like 15% of the market cap of the whole freaking company is available to buy back shares. That's huge. That is a bazooka of cash to support the share price of Alibaba. And I'm sure that has absolutely nothing to do with all the pressure that the Chinese government is putting on its financial industry to stop the sell-off in stocks, right? Probably got nothing to do also with the fact that China just changed their top securities regulator at the CSRC. That was just announced today. That's the equivalent of the U.S. firing Gary Gensler over at the SEC. That would be pretty big news, don't you think? If amid a 40% sell-off in the NASDAQ, if Gary Gensler were to lose his job, do you think investors might notice that? Well, that's what's going on in China right now. Also, we've got CVS reported today, big declines. They're saying there are losses in their insurance segment that a lot of people, we saw this with Humana, we saw this with United Health, that a lot of health insurers are really hurting right now because for years people put off elective procedures. People just were afraid to go to hospitals. They didn't want to catch the vid. And so they stayed home and they didn't have all those elective procedures done for a few years. Well, now there's a huge backlog of backed up things that people need to have done, treatments, surgeries. They're all getting it done at the same time now, and it's stressing the demand on health insurance services. So the insurers are all taking big hits. You can throw CVS onto that pile. Boeing's employees want a 40% raise. I guess that's the next big labor dispute we're all going to be talking about. 40% raises. Boeing saw what happened with the UPS drivers. They saw what happened with the airline pilots. They saw what happened with the UAW workers. And now the Boeing employees are like, we got to get us some of them big double-digit raises. And can you blame them? The cost of living has increased by so much in the last few years. They're doing the same work. They're adding the same value to the company, except for the guy who forgot to tighten the bolts on the door blowout panel thing. Well, the problems for Boeing just continue to mount. That's one I just wouldn't touch with a 10-foot pole right now. You guys do what you want with your own money, but the problems on a daily basis, problems for Boeing these days. We got big floods in Southern California going on right now, and that's important because state of emergency has been declared in 5 counties. In those 5 counties, virtually nobody has flood insurance. So it's possible there is a economic catastrophe in the making in Southern California right now as they swing from drought to flood in the blink of an eye. And oops, nobody's got flood insurance over there. And Nvidia's price target has been raised again. Why? Same reason my kids fight. Because. That's why. There's no reason. Just like, oh my goodness, look at the time. It's Wednesday. Excuse me, I'm late to raise my price target in Nvidia. Oh. Every day they just raise their price target. It is one big, as I said the other day, circular formation that is supporting each other. Why? I guess because I don't want to say circle jerk live on the air. Oh, did I just say that? That'll do it. That'll get you. Another analyst raised their price target in Nvidia because Nvidia only ever goes up, right? But pay attention, guys. I just put out that video last night. If you haven't seen it yet, go back and check that one out because the story about Nvidia making strategic investments in their own customers and their own customers turning around and handing that money right back to Nvidia, making it look like organic revenue growth. It's a process called round tripping. It's not necessarily illegal, but crooks have been doing it for years, notably in the dot-com bubble to inflate earnings. Well, the mainstream is starting to pick up on that. Jim Chanos has started to mention that. Dan Nathan at CNBC. There was an analyst note from Barclays. The Financial Times is covering it. If only somebody had mentioned that 6 months ago. If only. Nobody saw this coming. And with that, why don't we shrink my big melon of a head? And whoops, I forgot to share my screen this morning. I am remiss. And while we're sharing my screen, guys, don't forget that like button. It really helps with the YouTube algorithm. And if you're new here, hit that subscribe and that notification bell. We do this every morning, so come have your coffee with the Melon Heads as we go through markets. And markets are a lot of green this morning. It started right around 7:25 a.m. I was looking for a catalyst at that time, and I couldn't find what it was. But ever since 7:25 a.m., markets started moving higher this morning. We've got the S&P is up 20 or 0.4% higher ahead of the opening bell. The Dow is up 77 points or 0.2% higher ahead of the open. And the NASDAQ is up 103 points, 0.6% higher for the NASDAQ this morning. Stocks are green virtually across the board. We've got a slightly weaker dollar at 104.04. That's down 17 basis points, but still over 104. The dollar's had a pretty good run these last few days. Looking over at the bond market, not a lot happening in interest rates here. The 30-year yield is at 4.314. That is up a little less than 2 points this morning. The 10-year yield, 4.111. That's also up just under 2 points. The 2-year yield is at 4.414, up about a half a point. And the 1 month is essentially unchanged at 5.378. Looking over at commodities, we've got gold is pretty much unchanged here. April gold futures, $2,052. That's up $1.10 this morning, or about 0.05%. March silver futures, $22.44. That is actually down a tick, or about 3.5 cents. Platinum is down 2%. Palladium down just under 2%. West Texas Intermediate crude WTI futures for March are at 73.83. That's up about 50 cents this morning, or 0.7%. So not a lot happening in commodities, not a lot happening in interest rates, but it's the banks, guys. This is the one to watch over these next few weeks. NYCB's credit grade is cut to junk by Moody's. This is a big one here. New York Community Bank Corp's credit grade was cut to junk by Moody's Investor Services less than a week after the regional lender alarmed shareholders by slashing payouts and stockpiling reserves to cover troubled loans tied to commercial real estate. The bank is facing multifaceted, not just one facet, many facets, multifaceted financial risks and governance challenges, Moody's wrote in a report on Tuesday, lowering the company's long-term issuer rating 2 notches below investment grade to Ba2. The rating firm said it could go further if conditions deteriorate. The stock has tumbled about 60% since the bank announced plans last week to slash dividends and beef up reserves to prepare for stiffer capital rules following acquisitions that catapulted its assets beyond $100 billion. The measures followed mounting behind-the-scenes pressure from the Office of the Comptroller of the Currency, Bloomberg reported late Monday, noting that 2 executives overseeing risk and auditing had left in recent months. And guys, the red flags there, they're massive. That last sentence, 2 executives overseeing risk and auditing. You think maybe risk and auditing might be 2 important categories in bank management? I mean, we're not talking about the guy who just like locks up at night, or, you know, the guy who says hello when you walk in the doors. The freaking chief risk officer left and you didn't tell us? Come on, guys. And Carl Quintanilla is here on Twitter this morning mentioning this note from JP Morgan, who's mildly putting it here. They say, we were surprised that the news of executive departures, particularly for the chief risk officer role, did not come from NYCB directly. We think it is likely that the next catalyst will be a negative one rather than a positive one. The risk profile has pushed us out of our comfort zone as they downgraded to neutral. And guys, that's mildly put when they're saying we think it's likely that the next catalyst will be negative, not positive. When the chief risk officer leaves right before a disaster earnings report and the company tries to hide that information and doesn't disclose it, that doesn't mean something good is coming. It doesn't. I mean, so JP Morgan is right to downgrade on this news. Something really shady is up at New York Community Bank. And we had this one also from Walter Bloomberg on Twitter this morning. NYCB, their new executive chairman, Alejandro Danello, he says, if we need to shrink or sell assets, we will. Remember, that is what caused the run at Silicon Valley Bank. It was when Silicon Valley Bank decided that they were going to cut assets, that they had to sell assets to meet withdrawals. And then when the market realized how much money they lost on those asset sales, that's when people realized they were going to get to zero before they met all their withdrawals, and that started the bank run. So if they're just like, yeah, we'll sell assets if we have to, that's not reassuring. And Danello would go on to make a comment. He basically said something to the tune of, we have seen virtually no deposit losses at our retail branches. And, you know, there's a lot of qualifiers there. First of all, retail branches, they're mentioning like small accounts. He didn't mention like large uninsured deposit flight or anything like that. And also when he said virtually no, as my moderator Mish put it hilariously this morning, he said that's the bank withdrawal equivalent of largely peaceful. The withdrawals at New York Bank have been largely peaceful. Does that make you feel better? They have seen virtually no deposit losses from their retail branches. A lot of specific qualifiers in there to make that statement sound positive. Anyways, New York Community Bank, oh boy. You see, this just goes to show you guys, when you're in trouble, keep your mouth shut. Okay, I mean, this is from the guy who runs his mouth all day on YouTube, I guess, so take that with a grain of salt. But this bank was up 16% about 20 minutes ago when Alejandro started running his mouth, and now it's down at 1.4%. So Money just going up in smoke at New York Community Bank. And it's not just New York Community Bank, guys. Check this one out in Bloomberg yesterday. U.S. property fears send German lender bonds plunging. Bonds plunging, not a good sign. Losses in commercial property market, which have already sent some banks in New York and Japan into a tailspin, moved to Europe's biggest economy this week. Bonds issued by the real estate-focused German lenders slumped after Morgan Stanley analysts recommended clients sell senior bonds issued by Deutsche Pfandbriefbank because of its exposure to commercial real estate market in the United States. That's according to people with knowledge of the matter who spoke on condition of anonymity, anonymously sourced. Yeah, I get it. Nobody cites their sources anymore. The bank's 150 million euro, it's about $160 million US, their tier 2 bonds was indicated 17.4 cents lower at just 52 cents on the euro on Tuesday, by far its biggest one-day drop. We're not talking about freaking Evergrande here, guys. These aren't Chinese developers building tofu dregs. This is a German real estate bank here. Their bonds are trading at 52 cents on the dollar. While their senior bonds followed suit, a more junior 300 million euro additional tier 1 note fell 9.5 cents, an even sharper drop than the loss it recorded in the aftermath of Credit Suisse's AT1 wipeout last year. They're referring to how bondholders in Credit Suisse who should have been paid back before the shareholders lost everything in those AT1 bonds last year when Credit Suisse defaulted. And they're saying that the losses here are even more in these Deutsche Pfandbriefbank bonds than they were after that happened to Credit Suisse bondholders last year. The latter two securities slipped further on Wednesday. So bonds and German real estate lenders are tanking because of U.S. commercial real estate. This is going to be a global financial event, what's happening in offices and multifamily real estate here in the States. Shifting gears a little bit over to China, we've got Alibaba shares whipsaw in pre-market trade after a revenue miss, but a $25 billion boost to their buyback plan. That is freaking huge. Again, that is just a massive stock buyback. They're trying to sweep up just how bad their quarter was. Shares of Alibaba initially whipsawed in pre-market trade on Wednesday as the company missed market expectations for revenue in the December quarter, but announced it's increasing the size of its share buyback program by $25 billion. That brings the total to $35 billion. Now, I had the paragraphs highlighted. Son of a gun, I lost it. Here we go. Revenue missed expectations, growing just 5% year over year, logging a slowdown from the previous quarters as growth in the company's China e-commerce business and cloud computing division remains slow. Interesting, the cloud computing division remains slow. Pay attention, AI bros. That's not Nvidia. We're talking about Alibaba. Apples and oranges here, but they're apples and oranges that grow on the same farm, and neither one is doing particularly well. I'm just saying. Meanwhile, Alibaba's net income in the December quarter fell 69% year on year to 14.4 billion Chinese yuan. Never mind the 69% decline in our net income. Everything's totally fine here at Baba. The company said that this was primarily attributable to mark-to-market changes to its equity investments and to a decrease in income from operations due to impairments related to its video streaming service, Youku, and supermarket chain Sun Art. So Alibaba has made a lot of investments. They've bought a lot of companies. They bought a lot of stock. And, well, the Chinese stock market has sold off 40%. So Alibaba had to take a big loss on those investments, and it resulted in a 69% decline in their earnings. Now, Alibaba shares are under pressure this morning, actually down 4.7% ahead of the opening bell here in the States. That's despite a $35 billion buyback. Now, guys, I don't know if you can see it because the print is small here, but this is a $195 billion market cap company. So 35 over 195, that's 18% of the company's market cap is available in cash to buy back stock. Yet the stock is down. That's how bad this report was from Alibaba. Fire hose of liquidity coming out of China. And, oh, by the way, they just fired their top securities regulator. I'm sure that's a good indicator. China replaces top markets regulator as Xi tries to end rout. China replaced the head of its securities regulator, a surprise move that may foreshadow more forceful measures by Xi Jinping's government to end the rout in the country's $8 trillion stock market. Wu Qing, a banking and regulation veteran who earned the reputation as the broker butcher when he led a crackdown on traders in the mid-2000s, is replacing Yi Huiman as chairman and party chief of the China Securities Regulatory Commission, or the CSRC. That's according to the official Xinhua news agency. Again, this is like the equivalent of Gary Gensler getting fired at the SEC. They are shaking things up in China to try to stop the sell-off in China's stocks. And well, this morning, it looked like that may be working at least for a little while. This is the CSI 1000 index. That was up another 4.4% yesterday. That was after a big 6% increase the day before that. Again, still kind of like dead cat bounce territory here, but two big green candles in a row. Now, zoom out on the chart, guys. This one's got a long way to go to recover, though. China's stock market down 40% from its highs back in late 2021. We'll see. Is this little bounce here, these last two green candles, going to be enough to stop it? There are some people who are starting to call bottoms in China. I'm not trying to catch that falling knife, but there is an increasing number of people who are saying China has now fallen far enough. We'll see if they're right or not. Also, the Hang Seng Index not doing as well as the CSI 1000. That one was down again about a third of 1%. But still, we've got a little bit of a bounce here over these last few days. Things could be worse considering what they've done over the last few months. Now let's talk about back in the States here, CVS. We've seen this one with a lot of health insurers. This one continues. CVS cuts 2024 forecast as higher costs hit health insurance unit. Had a hard time getting that out. Higher costs hit health insurance unit. Try that one, Bravo, with your pronunciation. CVS Health Corp slashed its 2024 guidance for profit and cash flow from operations as rising medical expenses are expected to hurt its health insurance unit. Humana and United Health and other insurers are selling Medicare Advantage plans, private versions of the U.S. government's health insurance program for seniors. They've said that they're seeing members seek out more treatment since the pandemic has faded. The rising pressure presents challenges for CVS as it has been taking steps to expand further into healthcare beyond its brick and mortar stores. People are getting those elective procedures done, and it is hurting the health insurers. And, well, CVS, you want to be in the insurance business? Congratulations, you're in the insurance business now. CVS stock, though, doing all right this morning, up 1.4% ahead of the opening bell. Could be a lot worse, all things considered. And speaking of more problems for Boeing, this company just cannot catch a break. Boeing's next crisis, aerospace workers are demanding a 40% pay rise. Pay raise, not a pay rise. Sorry, I got my wrong tense there. I'm very tense this morning. Boeing company executives have spent the past month grappling with the aftermath of a near catastrophe of an airborne 737 MAX jet as the U.S. plane maker works through its latest crisis tied to manufacturing lapses. A new risk looms, a labor rift 10 years in the making. Boeing's largest union, the International Association of Machinists and Aerospace Workers, is still smarting over a 2014 deal that sacrificed pensions, locked in minimal raises, and tied the hands of activists for a decade. Union leaders will demand a 40% pay raise over 3 or 4 years, emboldened by a U.S. resurgent labor movement, a scarcity of qualified aerospace workers, and pressure on Boeing to stabilize work in its factories. So we saw similar demands from the UAW, and they got most of that. We saw similar demands from UPS last year. They got most of that. Now Boeing's workers are in line. Again, guys, I mean, look, all manufacturing problems aside at Boeing, and there's a lot of them, people saw massive hits to their standard of living, their quality of life because of inflation. They are producing the same work, and they are demanding to be compensated for it. And these companies that all raised their prices, passed on the cost of inflation to their consumers, their margins went up, and now the workers want a piece of that. And if they don't get it, they're going to strike. And Boeing can't handle a strike right now. Talk about getting kicked in the teeth while you're down. Boeing workers are piling on here. But again, I can't say I disagree with them because their standard of living has gotten hit. And they're also talking about a 40% pay raise over the next 3 to 4 years. So who knows how much money printing the Fed is going to do in the next 3 to 4 years to try to stop whatever is coming. So those 40% raises could go up in smoke in an inflationary flame pretty quick. So, yeah, I can't say I blame them. And talking about this one, California floods pose insurance nightmare for millions. This one, not really mainstream news yet, but we're probably going to be hearing more about this in the coming days here. Many of the residents whose homes were damaged by deadly storms now battering Southern California aren't covered by insurance, according to the latest data on coverage in the Golden State. The latest numbers from the National Flood Insurance Program, or NFIP, are part of FEMA that covers the flood damage, show only 52,820 homes and businesses in the 8 Southern California counties where a state of emergency has been proclaimed are covered by flood insurance, writes the Los Angeles Times. Those counties include Los Angeles, Orange, Riverside, San Bernardino, San Diego, San Luis Obispo, Santa Barbara, and Ventura counties. That means less than 1% of the 7.7 million households in these counties would be able to make damage claims for the storms of the past few days, writes CNN Business. So it could be something of an economic emergency on the horizon in California here. These floods came out of nowhere. They were in the middle of a drought. Now all of a sudden there's floods and mudslides, and well, insurance doesn't cover it. I don't know the extent of the damage yet, but considering how light the insurance coverage is, and already we've got a trend of home insurers and auto insurers leaving the state of California, this certainly is not going to help things. And the last one of the day, Morgan Stanley raises Nvidia's price target to $750 amid AI demand surge. Oh, look, another price target rise at Nvidia. And it's like these guys get together and they're just like, all right, guys, let's come up with Nvidia's price targets. Do I hear 500 from the man back? Do I hear 600 going on? 600 from the man from Bernstein, 700 from the man in the back who doesn't want to be left out. 800, do I hear 800 going once, twice? Oh, sold to the analyst for $750 amid the price target for Nvidia. And why is it going up? AI demand surge. Oh, that's new. That's new news, right? AI demand surge. That story came out of nowhere. We haven't been hearing about that since November. Whatever, guys, just keep raising your price targets. Definitely don't look at where the money's coming from. Definitely don't look at the companies Nvidia is investing in. I seriously, just pile into your calls. Good luck, really, guys. I wish you luck with that. Check out that video I did yesterday about the mainstream finally starting to cover what is going on Nvidia. But you know what, guys? Number go up. I got to tell you, Nvidia bulls, you have been right so far. That stock only ever goes up and to the right. And you know what? Trends like that, they last forever, right? They go on forever. They never end. They certainly don't take the elevator down at the end of that meteoric rise. We've never seen anything like that. And if you never sell, you never actually made any money. Just something I would throw out at the end there. And I want to say thank you very much to Mr. Eugene. Thank you, sir, for the super chat. He says, where did you hear that? Oh, some Twitter rando, nobody special. And there it is, guys, written right on my shoulder above Permabear. There it is right there. There is my patch. It says rando. I wear that name proudly. Remember, guys, do not get your investment advice from Twitter randos. That's disconcerting. Thank you very much, Eugene. I appreciate the laugh, sir, and the support of the channel. You are a gentleman and a scholar. And thank you, Steve Woitas says, yesterday's rando vindicated, a must-watch for melonheads around the world. Great work. Thank you, sir, very much, Steve. I had fun making that one. It's been a long time coming. I was just, let me just say, disgusted with the state of the financial press around that whole story. I mean, those videos that I did back in August and September got millions of views on Twitter. Nobody in the mainstream press covered it. I know they all saw it because I saw them tagging each other in posts back and forth to each other. I saw hedge fund managers tagging each other back and forth in the comments on those videos. So I know everybody saw it. They all ignored it. They just kept raising their price targets. And when the videos kept circulating, the only thing the press covered was this analyst note that didn't address anything. They didn't talk about Magnetar. They didn't talk about the shell companies or the carbon credits. Didn't mention any of that. Now here we are 6 months later, and they're starting to talk about it like it was their freaking idea. Well, the melonheads and the Twitter randos, they know better. They know where that one came from. Also, shout out to Kashyap Sharam, to Dario, to Kakashi, to Samantha Leduc, Finance Lancelot, the Mad King. There were so many other guys that contributed to this, people who dug into things, people who are like, NVIDIA's new elite partner, and they look up the company headquarters, and it's like a dirt lot in Hong Kong. I mean, there's so many people who are digging into this stuff, and it is getting no coverage. All you hear is price target raised, bullish surge, AI demand. So it remains to be seen. When I saw that note from Barclays, I felt vindicated. I'll stop short of saying was proven right. It hasn't been proven right yet. Just that other people are starting to notice. And now because these people are in the boys club, that are starting to notice. Now the mainstream has to cover it. When randos say it 6 months earlier, it's not news. In fact, the only news is don't pay attention to that, because that's what all those articles from all those news outlets were saying, was don't go look at what this guy on Twitter is saying. Forget his name, forget anything. It's just a conspiracy theory, as if, let's call it a conspiracy theory, because it's not the freaking 2020s, and the conspiracy theorists definitely aren't winning this decade, right? I mean, next thing you know, they're going to be telling you that germs are being made in labs, unleashing plagues on the world, or that there's islands in the Caribbean where the elite and powerful can do unpleasant things to children, right? What will those nutty conspiracy theorists come up with next? Oh, round-tripping cash at Nvidia. They're nuts. Nvidia would never do fraud, except for that time in 2000 when Nvidia did fraud, when they inflated their earnings by 15% by manipulating the cost of goods sold. And the CFO took full responsibility for that. And Jensen Huang, who was still the CEO at the time in 2000, he knew nothing about that, right? So you have to believe that Jensen Huang, the CEO of this $2 trillion company now, number one, didn't know that his CFO had inflated their earnings by 15%, in which case he's entirely incompetent and you're invested in a company run by an imbecile. Or the more likely outcome, that he did know that his CFO had inflated earnings by 15% and he chose to do nothing about it. In other words, he's a liar and a crook. And, well, in my opinion, there's no statute of limitations on being a liar and a crook. That doesn't change just because it was 20 years ago. And so if he would do it then, what's stopping him from doing it now? Or he's just an idiot and he didn't know his CFO inflated earnings. Either way, it's not a very bullish case for Nvidia. Go check out that settlement from 2000, guys. They inflated their earnings by 15%. Oh, and by the way, Nvidia, that's the company that replaced Enron in the S&P 500. That's fun, isn't it? Thank you, Steve Boyd. Appreciate the super chat, support of the channel, sir. And thank you to Mr. Alex Lieberman. It says, how does Amazon post a record quarter with nice profits from drop shippers, but Alibaba loses so much? Well, Alibaba's losses were not so much tied to their core business, although their core business growth did slow, Alex. But the big losses in Alibaba's quarter was, they mentioned mark-to-market changes. Alibaba has invested a lot of money in other companies. And while their e-commerce business, the growth is slowing, they are still making money there, but their investments lost so much money. And when their investments go down, that shows up as negative earnings on the report. So really what we saw with Alibaba in their terrible quarter was the result of Alibaba's share of that decline in the Chinese stock market that we've seen over the last few months. It's dropping the value of their investments and it's hitting their earnings. So that's why they could still be so bad. Now, converse that with Amazon. Amazon doesn't have the exposure to the Chinese companies. Now, Amazon has seen similar things from their investment in Rivian in prior quarters. Remember, I think it was in late 2022 or mid 2022, Amazon had some terrible earnings because of a big decline in Rivian shares. That's kind of what's going on with Alibaba here. Also, Amazon is the beneficiary of this buy now, pay later thing that's going on right now. I've done videos about that. People just indenturing themselves, going further and further into debt to get stuff that isn't going to make them happy, and they're going to regret it in the long run. So, you do have, it's two pretty different comparisons there between Amazon and Alibaba, despite them having pretty similar business models. But that is it's a good observation. But I think it's got more to do with the Chinese stock market than their core business. Thank you very much, Alex Lieberman, sir, for the super chat and the support of the channel. And thank you, everybody, for having your coffee with the Melon Heads this morning. Don't forget to check out that Rando's Vindicated video. It's on X, where you can still see that video. I don't know why my other Core Weave videos were taken down on X. Elon, any update on that? Maybe. I don't know. Just suspicious timing. You can still see all those videos on my YouTube channel, though, so check those out. Thank you very much, everybody, for the super chats. Thank you to my Patreon supporters. Looking forward to talking to you guys at 6 p.m. Eastern time today on our weekly Zoom call. Links down below to all that good stuff should you feel so inclined. Hi, Mom. Hi, Dad. Love you guys. Everybody, till next time, live small and dream big.